Morning, ladies and gentlemen, and welcome to another hedge fund webinar hosted by BCI. I'm Pierre de Klerk from Apex Investment Consulting. We are a sister company to BCI. We work closely with them, and we do asset consulting to independent IFAs with substantial investment businesses or investment books, and to institutional investors. So thank you very much that I can host the panel. We've got quite a full program today, 5 speakers all in all. So I'm just going to run quickly through the list. First up, we're going to have Patrice Mouyal from Visio, the founder of Visio. He will be followed by Matthew Auerbach, calling in from London, and Matthew is from Anchor Capital. After them, Gareth Montano from Corian will be next up. Gareth is also a founder of Corian. And after Gareth, we'll have Werner Prinsloo from Exchequer. He's also a founder of that business. And then lastly, and hopefully we have enough time for that, we've got an interesting gentleman for a bit of a fireside chat, Gideon Nieuwoud, from Southern Right Capital. Gideon has a wealth of international hedge fund experience in an earlier life, essentially, and I thought it'll be nice to have a discussion with him. So thank you very much for joining us, gentlemen. We're really looking forward to it. And before we kick off with Patrice, I just want to maybe give a brief introduction from my side as well. And as we go through the presentations, you are welcome in the audience to ask questions in the Q&A box. If we do have a bit of time after each presentation, then we'll take the questions. Otherwise, we'll try and take the questions at the end, or otherwise we will circulate them certainly to the managers for answers, and we'll get back to you. So we're a bit flexible on our time. We'll see how it goes. When we have time, we'll take the questions. Just want to share a slide or two that I want to very briefly cover as introduction from my side. And I think the first thing I want to say is I know in the audience listening today, there will be people who are quite sophisticated in terms of being hedge fund investors, who feel they know it well and they have been investing in hedge funds maybe. But certainly there are people who are not that familiar with hedge funds, and maybe have not invested in hedge funds before and haven't included hedge funds in their portfolios before. So it's really, at the start, maybe just for a minute or two, if the more sophisticated investors will indulge me, then I just want to cover a bit of basics for the benefit of people who are newer to hedge funds, just to set the scene. And the most important point, really, when at the starting point of discussion about hedge funds with clients, what I want to say and focus on is that one must realize that hedge funds is not a homogeneous asset class. There are different hedge fund strategies, just like we find in the long-only space, and those different strategies have different attributes and different characteristics. So when one start thinking about including hedge funds in your portfolio, and often a client sit with us and say, can we include hedge funds in their overall portfolio? When you're at that point where you want to do it, I think it's very important to firstly focus on the strategies and what differentiate them, and to really get a handle on their characteristics and that of specific funds then. So it's a bit of, when you build something or you fix something, you start with a nail and you look for something to hit it with, and you find a hammer. It's not a case of you find a hammer and then you see what you can hit with it, So in the context of your overall portfolio, you need to know what you're looking for and what role it will play in your portfolio. So I thought maybe at the start, just to briefly show you what the the lie of the land looks like in South Africa, and this comes from the Novare survey. Most of the hedge funds available in South Africa are long-short funds, so they give you a degree of exposure to the market. And in that long-short component, most of the funds has a long bias. You expect them to have some sort of a positive beta to the market. They will protect downside as well, but they are directionally biased towards the upside. Also in the long-only space, there are other types of long shorts. So there are variable funds that can change their bias. There are short funds, but they're in the minority, short bias funds. And then there are market neutral funds. And a market neutral fund essentially try not to have a significant degree of market directional exposure, but really to harvest alpha. Then in the big circle again, you can see apart from long short, we have fixed income hedge funds, multi-strategy, which includes all the strategies essentially, plus things like commodities and so forth. And then the other basket is really the commodity funds and a few other interesting strategies. So I just thought to show you what the hedge fund universe South Africa kind of looks like. And when I go back to the point that I made about understanding the strategies and thinking about the role that it can play in an overall portfolio, what is instructive to look at is a graph like this that shows the return dispersion of the different strategies. This is again from the Novare survey, and this is for the year of 2023, but it doesn't really matter which year we're looking at. You know, this it's a stylized example just to give you an idea of how the different strategies behave in different years. The levels might be different, but the important point to make is that the different strategies have different dispersions of returns. So you can see market neutral is a much narrower dispersion of returns compared to long short equity. For example, the lines on the graphs, it's called the box and whisker graph, and it shows the quartiles. So the colored blocks are the middle two quartiles, and then the top end and the bottom end are the top and bottom quartiles, and the little dots are any outliers or extremes. So as you can see, long short equity, because of the gearing and the directional exposure that it has to the market, has the biggest dispersion of returns, depending on whether the manager gets it right or wrong, that's the way to put it, I suppose. Market neutral, much tighter. Fixed income generally much tighter, but there can also be quite a spread. And because of the strategies employed within fixed income and the gearing that it can take, it's not quite as simple as fixed income in the long-only space. There's certain things to look out for. And then multi-strategy, also quite a broad dispersion. So saying again, if you want to put multi or hedge funds into your portfolio, as you can deduce from this, putting a market neutral fund in versus a more aggressive long short equity fund can have a very different impact on your overall portfolio, and you need to know what you want to include, what you want to achieve, and how you want to blend the different strategies. So if we maybe look at it in a different way, in the context of an efficient frontier, like a market-rich efficient frontier, then adding alternative investments like hedge funds to a more traditional portfolio can achieve one of a few things. It can either enhance your return, so you can choose hedge fund strategies that you believe and you model in your portfolio. They will, for the same amount of risk on the x-axis, enhance your return, so you can include them as return enhancers, or you can pick, let's call it, for lack of a better word, more conservative hedge fund strategies, where because of the less than perfect correlation to the other elements in your portfolio, you can, for the same amount of return, create a portfolio with a lot less risk. And then obviously there are variations in between where you can reduce the risk a bit and enhance the return. So I think that's the important point for me to think about at the start of looking into hedge funds, the different strategies, the different behaviors, and really understanding them. And therefore, when I brief the managers who will present today, I said to them, please strike a good balance between talking about macros and bottom up stock stuff, but make sure that you also talk about your strategy and really the characteristics of your strategy and your specific product, so that the audience get a good handle on that, because there's certainly a lot of value in that. So on that note, I'd like to hand over to Patrice for his presentation, and then we'll take it from there. Thank you, Patrice. Just going to unshare, and you can share.
Right, thanks, Pierre. I'm going to do it now. Just let me know if it's working.
Yes, we can see it. You must just put it in full screen. Yep, there you go. Perfect.
Okay, Pierre, thank you for that useful introduction, because it's up it's a good platform from which to kick off. Firstly, thank you to Pierre, Olga, Tanya, and both your teams. Thank you so much for the opportunity to be able to present to your audience. So I'm going to go, we've got 20 minutes. I'm actually going to put my timer on so I don't mess around. There we go. Okay, so I think maybe just by way of introduction, perhaps I'll just go to the next slide first. These slides will be available. We'll send you the PDF afterwards. Maybe just by way of introduction, I've been in hedge funds since 1998. Johnny on fixed incomes for even more than that, 30 years. And we've had a team that's been together, and some of us have been together for 18 years now. So we've got a long team, long-lasting team, very diverse, a range of qualifications, as you can see on the right-hand side, which lends itself to really a diverse range of views and skills. And we don't try and silo everyone. So everybody's very much involved in decisions at all levels. And we kind of throw people at the deep end, to be honest. So everybody has to generally fend for themselves and generate ideas. So it's really a very dynamic bunch. And by virtue of that, we found a lot of ideas, and we're happy to take risks. What differentiates us and why we thankfully been doing hedge funds for a long time and it works well, I think we've always been of an absolute return mindset. And that means that we're not guided by the index. That is something that is very typical of hedge funds. We prefer to be very concentrated. So you'll see in the middle there, middle block, activism is important. Concentration of the portfolio. We have fewer shares. We don't have a long tail. We don't have 0.5s and 1%. It just doesn't pay. If you have conviction, you have to have proper positions in a fund. We do get involved in a lot of activism. We don't do it above radar. We do most of it through written correspondence and a lot of communication with companies. We don't try and antagonize boards. We like to do it, by working with them and being constructive. I'll show you examples later. And that's really to try and influence returns, because at the end of the day, we're not quite sure what Trump's going to do next, or Xi's going to do next, or anybody else for that matter, but we should try and be able to be more influential in what the CEO of one particular company is going to do, and how a board is going to manage either value unlocks or ensure that incentives are appropriately structured, etc. So we're really trying to be more bottom-up, more macro-focused, and that's really where the returns are going to come from at the end of the day. Irrespective of market conditions, companies could outperform. That's the bottom line. And you can do that in concentrated portfolios. And the benefit of hedge funds is you can take opposite positions where you are short something. In other words, you sell something in the expectation it's going to do badly or not do as well as another company that will do better. And that gives you, firstly, extra capital to work with. Secondly, a bit of protection in case markets fall. The bad company should do worse than the good one. So these are all sorts of things that you can do in a hedge fund that you can't do in a conventional long-only portfolio, where sometimes you have to be 95% invested with an index. So it's really far more efficient in a hedge fund to do things than it is in a conventional long-only portfolio. In terms of correlation, I mean, to your point, Pierre, you can see that hedge funds, by their very nature, should possibly not capture a lot of the upside, but certainly manage the downside. And that's the most important thing in hedge funds. It's the most important thing that guides our mindset, is what is the downside? What is the risk that we are going to lose money? And if so, how much money could we lose on a position? And I'm going to steal this from somebody else. I think it was Stanley Druckenmiller, or maybe it was Howard Marks. It's not so much how much you lose or how much you make. It's how much you lose and in a position that you don't size properly. If you have high conviction, put a lot of exposure in it. If you have low conviction, put low exposure in it. So when you lose less. And when you make more. So it's about sizing positions, but it's also about being very risk averse and not potentially following the herd into popular trades, which in many instances we may be short shares that are very popular. And there are quite a few examples of this over the years. So just really, again, this is a very important slide, mostly in terms of the bar in the middle, that in bear months, we tend to outperform. And if you can protect the downside, if you lose less money than others, when things are bad, generally your returns will be good over the long term, and you're compounding far more favorably. This is just another example of how low our correlation is to the markets generally. It's not new. This is in fact, this slide is 19 years old. Our longest hedge fund is 22 years old now. This one was started 3 years later. But in essence, you can just see that we are not correlated to the market, and it's not really something we do by design. It's just something that happens because of the mix of holdings that we have in the fund. Sometimes it's bonds, sometimes it's ETFs and commodities. It's the short positions that play a role when markets are falling. So it's all sorts of things that cause for this completely uncorrelated picture versus the market. Again, to talk to lower correlation, I mean, on the right is the current positioning of the fund. Again, it's not by design. We're not trying to have more blues than reds or etc. It's just that we are very much bottom up. We take full cognizance of what's going on around the world. And times like this, it gives us a lot of opportunity to actually pounce on dislocations, pounce on stocks that ideally we would have liked to buy, but were higher, in which instance we can now buy cheaper and potentially sell some things that have outperformed in these times and say, okay, well, let's switch into things that have been smashed that are interesting. And in the reverse, we were short MTN, for example. We covered those 10 days ago. We were short Foschini, for what it's worth. We covered that too. I mean, it was because we didn't like the Foschini business in its current form, essentially. And there are other examples. So there have been some shorts that have performed, and we took advantage of this volatility. It doesn't mean they're not good companies. It just means that they were, in our view, mispriced. Very good example of what happened in 2009 was with the global financial crisis. We had some 20% of our funds in corporate bonds. We were so fortunate to be able to invest in these at the time. The old mutual bonds, Standard Bank bonds, this is debt paper that was paying 8% in dollars or 7% in dollars, and we could buy them at discounts of, at 50% in the rand. In the instance of Old Mutual, we paid 28% in the rand. So we paid $28 for $100 paper. We got an 8% yield on the 100, which means it was more like almost 4 times that at 28%. And then 3 years later, we got 100% back on the Old Mutual bonds. And Old Mutual wasn't going to go bust. So those are just examples of how erratic the market can get. In COVID, the only one that really fell out of bed was Sasol. And we put 5% of Sasol bonds at 55% in our funds. Even our long-only flexible 10-year fund that is just generally equities, we stuck some Sasol bonds in them. So this is just the opportunity set that's out there that we can take advantage of in a hedge fund that you really typically can't do in a conventional fund. Some examples of where we are seeing event-driven opportunities, and we listed here domestic ones because they'll be more familiar, but they are almost 20% of the long book, the long positions in the fund is just these 4 stocks. It just shows you the level of concentration where we are confident in, firstly, the downside being quite minimal, and then obviously you're not paying them for the potential optionality of the upside. Renet, as you may know, is the biggest holder in Pensions Corp in the UK. You would have heard us before talk about the pensions risk transfer market in the UK, where defined benefit plans are moving across to companies that are happy to take on the risk, and they assume the embedded margin in those defined benefit plans. And obviously, over the next 10 to 15 years, you have tremendous cash flows coming from taking over these books. Renet is Johan Rupert's vehicle in the UK. They've just sold all the last remaining holding in cigarettes. Essentially, the stock's trading at a 45% discount to NAV, but half the market cap as it currently stands is cash. So we're getting a massive discount. We're getting a great business in Renet, and the balance of the stock is in cash. So we are engaging with Wilhelm in a friendly manner because we really want to work with him. And we would love for them to just all day long be doing buybacks and buy back what we think is prime asset, beautiful asset in Pensions Corp, which makes up essentially 70 or 80% of the, in fact, 90% of the residual value if you exclude the cash. What a great business to be invested in. It's unlisted. Alexander Forbes, we've been in it for 5-6 years now, engaged a lot with the board, engaged a lot with management. Our compound return here is over 40% in the last 5 years. They've returned enormous amounts of capital. There remains 15% of the float, free float in shareholders, ourselves, PRC, one or two other small ones, and that's it. Great business, over 100% cash conversion. Its peers traded massive multiples. Invicta's more recent, it's about 9 months old. CSM with CMH, lovely small caps on the South African exchange, totally neglected. No one covers them. Invicta's trading in a massive, in fact, we've got a slide on it. They bought back 10% of their market cap just in the last 3 months, in case anyone pays attention. We do. And the same with CMH. Management is close to 80. They've done a phenomenal job. Business is extremely cheap. So got maybe 2.8 billion market cap with 800 million rand of cash, of free cash. So it's a silly valuation. No one covers it. Happy to hold it. We know that at some point value will be unlocked, and to the extent that we can, we will engage, and we are engaging on a friendly manner to see how best that value can be unlocked. These are examples, and they'll be in the slides, of companies we've engaged with before. Some are work in progress. They don't always work out. Some are value traps in the sense that we start a bit too early, but over time we do believe that value will be realized. But it really takes a decent slot of work. It takes good writing skills. It takes friendly engagement, constant follow-up, and understanding the companies well in order to ensure we're not going down the wrong route. These are examples of our letters to companies over the years. We were extremely successful, along with 2 other hedge funds in the Fortress situation, where they were the Fortress A's and the B's, and we were instrumental in ensuring that Fortress would de-REIT. In other words, not be able to pay dividends, and made some enemies along the way, but we made double our money essentially on our Fortress shares, because we were given on top of it NEPI shares in exchange at the end, which have done phenomenally well too, and we still hold those. So that was these take time, and you write the first letter. I think it took 18 months to get the full unlocking of value within Fortress, almost 2 years. Northam's another one. We took a good position in Northam. It was discounted because of the risk they were going to do this silly acquisition. In the end, we had to go above radar to make sure that our disagreements were actually aired publicly. We didn't think we'd get enough out of the board if we didn't put some extra pressure. So this was April 23. And in fact, after the board decided not to go ahead with the RB Play deal and instead keep the 8 billion in cash, the stock went up. So these things do pay off. Another interesting one, and this is where your short works well against the long. We've been short Discovery, and I get on Nevo's on the board of Rengro, but we've been short Discovery for the better part of 10 years. And in exchange, I mean, not for the last 10 years, we only bought Momentum, not in the last 10 years, but Discovery has been something that has not performed well for many years. But examples where you find in the same industry companies that were deeply undervalued and have really performed well, and Momentum is a case in point. And again, there we've written to the board, we've engaged with them, we have a constant contact with them, and we think what they're doing, capital allocation, buying back shares, extra dividends, focusing on their own business, cutting out costs. It's like a doge within Momentum that's happening currently. They are doing the right things for the right reasons, and it's reflecting in the share price. We've more than doubled money, including dividends, in 3 years, 300 years. It's not often one can do that in the South African Stock Exchange. I'm running out of time. I've got 6 minutes left. I'll be quick. Education, something. So a hedge fund doesn't mean you're going to trade all day long. We have been sitting on Advotech shares. I personally have had them for 20 years now, more than 20 years. But in the hedge funds, we've been on Advotech for 10 years at least, sometime on and off before then. Education is an incredible theme. You could be short the market, it would have returned 9%, or cost you 9%. You would have a compound return in Advotech of 18%. If you invest in good themes, good companies over the long term, you hedge it out against an index, for example, so that you kind of iron out volatility. These are the types of returns you can make from good, solid businesses in South Africa. Invicta, there's a couple of slides on Invicta. I think the important point I want to make here is that we actually lay out the cash flows of Invicta, what they've been traditionally. It's a well-run business. Christo Visa has over 50% of the shares, more than that actually. Related parties, friends, etc. The free float is not very high anymore. Could be 15 to 20%. When a company is buying back 10% of the shares, bought back convertible prefs, CEO bought 1% more for himself earlier this year. I think you can tell that the signs are good. It doesn't take a rocket scientist. Fairvest, another one where we engineered with some other hedge fund, and we helped along the process of Fairvest merging with Arrowhead. I mean, we've more than doubled money, and we still long Fairvest, and it's now a 9% dividend yield, distribution yield. So you can get involved as a hedge fund and stay long. And in fact, it's 7% of some of our funds on a 9% yield. Just here's some more on Forbes. I think the important point on Forbes on the right-hand side is how cheap it is relative to its peers internationally. The bottom line, Forbes should not be listed. It has no merit in being listed anymore. Such a small free float generates massive amounts of cash. We'd be better off unlisted and not showing everybody how well it's doing. And it's a great business, very well run. International, same things apply. We're not as active because we really can't be that influential with the size of these companies, but we certainly look for the same characteristics. And if we can't be active, we look for others who are active and who essentially could do the work for us. So then we don't list some of the activist companies we invested in on the slide for our own reasons, but we very much enjoy it when other companies are getting stuck in, and we quite like the breakup values or the arguments why certain of these activists are investing there, and then we will participate and just have positions and follow the process. But there are some key themes in the hedge funds, which again, you can invest in directly as a hedge fund. We're making full use of all of our tools and offshore capabilities. And we kind of break them down. Emerging consumer urbanization, that's really just the amount of spend that's happening and the whole transformation of that spend in its various forms, and how the likes of Amazon and Meta are just transforming the way we think and consume. Universal Music Group's interesting. They publish and produce music and distribute music, totally tariff-free. No one said they're going to stick music tariffs on music. No one's going to go and charge ABBA for consuming its music in the US or U2 in Japan, etc. So really, it just completely gets through all this noise out there. It goes without saying, Microsoft, we treat it as a utility because everybody uses it all day long, every day, every business, every individual. It's a utility. Treat it as a utility, and it's evolving immensely. On the right-hand side, we keep hearing, and we do a lot of work around that, on the amount of energy that the US needs. They call that electrons. They need electrons all day long. They're all running out of capacity. There isn't enough power generation. We've picked two very interesting stocks in that space. GE has been there for a little while. And I'll just talk to the bottom very quickly. We're finding great value in financials in Europe. The first two, UBS and Societe Generale, are both at very attractive metrics. UBS is bloated the capital. The government wants it to keep it. The board says it shouldn't. There's going to be a middle road somewhere. There's potentially a lot, and the stock has come down 15 to 20% since results, since the government regulators said we want to see more capital. It doesn't make sense. The board is fighting on the other side, and there'll be a middle road. The stock dropped a lot, so we took advantage. Still low. Societe Generale, a lovely bank, super cheap, still very cheap. Government management's doing the right things to fix the business. And again, that's something we put 3% in the hedge funds. It's not a conventional fund. We probably sit with 1% and have the other two banks. We were very focused. Legal in general, just also play the same as Renette in the pensions risk transfer that I mentioned earlier in the UK. Great in theme, great industry, great cash flows in 3 to 5 years time for the next 10 to 15 years. That's not priced in. So I think I've run out. Maybe last slide. Yep, the last slide. Just on rising spreads. We are dying to see spreads widen in terms of corporate bonds. Maybe they will. If they do, there's some great opportunities in corporate bonds. We do run a corporate bond fund, and again, we're very actively on the lookout. It's a good place to invest when there's dislocations globally, and we have space in our hedge funds for those. On that note, I hope I've covered some of what you were looking for, Pierre, and your audience. And yeah,
thanks, Patrice. Thank you very much. Maybe one question. We only have time for one question with you, but about your hedge fund, you clearly invest in South African shares and in international shares. Are there strategic ranges that potential investors should be aware of for your local and your global kind of exposure, or is it really very flexible and you simply go where the opportunities are?
Yeah.
And sorry, secondly, and how do you deal with currency exposure?
Yeah. Okay. To the latter of your question, we are not driven by local versus offshore. It's really a factor of what we find attractive, and then we weigh whether it's worth buying this as opposed to that. And most of the time, it's really that. So then. So we don't look at that offshore versus local. And as far as currency exposure is concerned, we pretty much don't hedge anything. We did invest 6% in Japanese shares this time 2 years ago on the theme of unlocking value in Japan. It was 10 shares times 0.5% each. And then generally, I think we did about 15 to 20% after the currency knocks. We didn't hedge the yen, because the yen was so weak already when we bought in. So we made nice money, and we've since subsequently sold 4 of them. 5 of them, we're down to 5. But we've got good returns because there's a lot of value unlocked there. So we can't speak Japanese, we can't write in Japanese, so we're allowing others to do the work for us.
To do it for you. Cool. Thank you very much. We'll get back to you at the end, maybe with more questions. But thanks for your presentation. It was really very insightful.
Thank you very much.
Thanks, Patrice. We'll move straight over to Matthew from Anchor Capital. You're welcome to share, Matthew.
Hi, guys. Yeah.
And I must say, I omitted to mention in my introduction that I also briefed the managers to give insights as to what they think the most pertinent questions are to ask of a hedge fund manager in the context of their strategies. So you'll hear some of the managers comment on that as well. Thanks, Matthew. Over to you.
Hi, guys. Can you see the screens?
Yes, 100%.
For some reason, it's not working.
Maybe unshare and reshare.
Okay. Okay.
It's still not.
Still not. Can you see it now?
Yeah, there's moving. Yep.
Okay. Sorry about that, guys.
No worries.
Yeah, first of all, thanks very much for the opportunity to present. Yeah, we've got about 20 minutes, so a lot to cover. And just in terms of what we look today is just to show and spotlight the stable fund. We run several funds here. Then just also with this current market volatility, just for the audience to see some of the benefits and highlight some of the benefits that sit within a hedge fund that you may not be able to get with your normal long-only investments. And then, as Pierre mentioned, questions to ask your hedge fund manager. So just a bit about Anchor, a global business with 250 billion of assets under management, covering unit trusts, hedge funds, and seg mandates, private clients, asset management, and an experienced and high-quality team. But just focusing more on the long-short equity hedge fund, it's got a 20-year track record, 1.7 billion of AUM, fundamental bottom-up investment approach, and more importantly, processes defined, settled, and established with consistent alpha generation and a quality underpin. The team, Liam, Damon, and myself. Damon and I started together at Capricorn Fund Managers, which was the fund that morphed into the Anchor Stable Fund from 2005. So the team is together. We've got Mike Ledgeridge, who helps on the trading side, as well as Julia, who handles operations. So what are the core principles that we're looking at? As Patrice mentioned, one of the most important things is capital preservation and risk management. So what we are able to do is move our nets and our risk tolerance around to take advantage of the right environments. And we use extensive use of downside protection and often put options to make sure that the downside is protected. On the flip side, a fundamental bottom-up approach where we go and we do fundamental analysis and looking for stocks which tick our checklist of what we are looking for. What also differentiates us is we've got a core and a tactical approach. You know, so as Pierre mentioned, every fund is different. In terms of our core, there's a core portfolio of quality companies, but then to complement that, we take advantage of short-term tactical opportunities. So when things are oversold or when there's an index reweighting or some form of price action, which creates an opportunity to take advantage and generate alpha and returns. So what does the ideal investment look like? Something with a high ROE that is stable and improving, good, strong free cash flow, strong brands. Not only do we buy companies and stocks, we buy businesses, and we like to look and say, what will that business look like in 3 to 5 years' time? It's not just about this next quarter, it's how the business can transform itself, how it can have leverage and really grow, and there's a visibility and reliability of earnings, which we like. Then in terms of management, we place strong emphasis on management, just like you as investors place strong emphasis on the quality of the investment team. So do we look at the management team of these companies and make an assessment of them. So in terms of our fundamental long-short equities, it's a quality compounding strategy, focusing primarily on earnings and dividends, stable portfolio. In the core, we don't change these too many times, and there's a strong emphasis on capital preservation and risk management. So just having a look at our track record, which we're pretty proud of, you can see that over pretty much every time period, we've consistently outperformed our benchmark. And if you have a look over time, there's a strong, consistent compounding with few drawdowns. And that talks to our capital preservation strategy, where if you manage the downside, when you start getting the upside swings, that is where you make the most money over the long term. And now just to, especially for those that are fairly new to hedge funds, and apologies to those that know it well, but to me, the three big benefits of hedge funds in these difficult markets, and I think everyone that's seen, and we're only halfway through the month, what a month April has been, the three benefits that I see of hedge fund, the three main ones, is the ability to adjust your net and gross exposure, your ability to short, as well as to play relative value opportunities that really generate returns while reducing the market risk. So let's talk about the ability to adjust net and gross exposure. If you have a look here, we're on the picture, we can see two roads. One probably a road in Cape Town, the other one probably in Joburg. But when things are smooth sailing and you've got that clean road ahead of you, you can expand, you can run high net exposures, high gross exposures, and everything's good and you're in a bull market and you can see clearly. But when things turn to the road on the right, that potholed, difficult road, what do? We bring down our exposures, we bring down our risk, and we travel slowly. And so what we're seeing now is a very difficult market where Trump's tweets are moving around, a lot of volatility. What have we done? We've brought in our net exposure, pretty much halved it. We've brought in our gross exposure, and we're keeping a very tight ship, waiting for the storm to clear, to get a bit more clarity of how things plan out. And from there, when we see smoother roads, that's when we'll expand the gross and net exposures again. So you definitely need to adjust your risk based on the conditions. Yeah, another opportunity is the ability to short. I mean, you can have a look at any pretty much chart at the moment, and you've been able to profit from the downfall in the share prices. This is just a simple chart of the S&P. When the trend line broke, you shorted, and now you've made money. And then the final one, in terms of looking at opportunities to create value, is to do a relative trade. So over here, we're talking about Mr. Price and Truworths. Mr. Price, we chat to management. The wind is in their sails. They're doing really well. They're seeing the returns. Truworths, you chat to them. The sales aren't there. Management don't even know why the sales aren't there. They have to rely on credit. Have they become too pricey relative to the peers? So you can see that Mr. Price is actually a fundamentally better business in its current form and has been for some time. So being long Mr. Price and short Truworths has been able to generate your returns irrespective of what the market has done. Whether it's crashed or rallied, you've been able to generate returns. And now just some important questions to ask your hedge fund manager. I think in terms of return expectations, to me, it's all about expectations. What do you expect from the manager? How much upside capture versus how much downside capture? We often see, like, you guys as hedge funds are supposed to make money in any market. In a bull market, you're supposed to make as much as the long-only guys. In a bear market, you're supposed to beat cash. That's a bit of an unrealistic expectation. So you just got to sit down with your manager and work out what to expect on the up and on the down, so that when the down happens, it's expected and you don't have this big hoo-ha. You pull your money because it's not what expected. But meanwhile, that's what the manager had in mind. What's your process and how is it differentiated? There are various managers here, all covering the South African market and global markets, but we all have different styles. Patrice, who you saw now, is very small cap, getting involved. We far more of a thematic trading style. Other managers may have different styles. Your ideal market, when do you do well? Are you a trend follower? Are you a deep value guy? Are you small caps? Understand the vehicle that you're investing in. And then when do you expect to underperform? We'd love to be good all the time, but for example, at the moment, where we're getting chopped around and Trump's making a tweet here, and it's all news-driven flow, which is slightly unpredictable, that may be a difficult market for people who are trying to identify themes when these themes are moving around so quickly. The market ahead for the next couple of periods looks to be quite a tricky market where you've got credit spreads moving, governments need to refinance debt, you've got a potential slowdown. We saw that from LVMH numbers yesterday. Got an interesting earnings period coming up. So for us, we felt that this is the right time to reduce risk a bit and let the storm pass, let it get clear. And then when we know what's going on, we've got a bit more clarity, a bit more conviction, then we'll look to expand the exposures again. So I've kept it short and brief and giving lots of time for questions. And yeah, just in terms of the stable fund, been around for 20 years plus, consistent performer, strong capital preservation. And, you know, you've got two types of hedge funds, a get-rich hedge fund and a stay-rich hedge fund. And to us, this is definitely a stay-rich hedge fund.
Thank you, Matthew.
Yeah.
Very interesting. And yeah, like you say, we've got a few minutes for questions. Maybe on picking up on your conclusion where you said you think market conditions might be quite tough for the foreseeable future, and you have reduced the risk in the fund. Can you maybe say a bit more about that? What is the current net exposure?
So yeah, I mean, if one has a look, when we had the GNU and the Trump tariffs all on one day, volatility spiked and we brought our net exposures down from, call it early 40s to 20%, which is the lows. This fund has a maximum 50% net long exposure. So it's never going to keep up in a big bull market. We kept it tight with strong convictions and kept it quite balanced in terms of where we would play. And, you know, the Aussie is actually quite an interesting vehicle to hide in because it has the best of a lot of worlds where you have a rand hedge exposure, gold, as well as South Africa.
You have two retail hedge funds, the stable fund and the accelerator fund. In terms of their classification, as per CISA, they are both in the long-short, long bias category. But can you maybe, for the benefit of the audience, just kind of draw the distinctions and the differentiation between those two products?
Absolutely. So if you have a look, the accelerator fund is got a much higher net exposure, much higher conviction in positions, and by nature would have a higher risk. So that's more like the get-rich hedge fund, whereas the stable fund is more like the stay-rich hedge fund.
Thank you for that. And following up from that, there was a question from the audience that came in. Unfortunately, I saw it late, so I'm not 100% sure whether it was directed at Patrice or at yourself, but I'll ask you in the context of your products. And the question was, what are your maximum and minimum, but I think the focus is on maximum position sizes, and what's your maximum gross exposure? So again, just speaking to the kind of the risk profile of both the products.
So max our mandate is 10%, but in the stable fund, you know, 4 or 5% would probably be a large position. Probably the one exception to that is Naspers, where we've held it for some time, and we just see such value there with the company doing a buyback, Tencent doing a buyback, and the company in the underlying businesses, you know, hitting the J curve in terms of profitability. In terms of gross exposure, we're trying to keep it pretty tight at the moment. So it's actually sub 40-50% at the moment, just keeping a very tight ship while we navigate these tricky waters.
Is that for the stable fund? The last
That's for the stable fund, yeah.
And for the more aggressive fund?
For the more aggressive fund, we're roughly sitting at 60-65% net exposure. That was above 80. We brought it down to sub 50. And quite recently, in the last couple of days, we've taken it up to 60-65%. So yeah, just in terms of gross exposure, we also fairly keep it tight. If there aren't good opportunities on the short side, we're not going to waste net exposure or gross exposure for the wrong type of opportunity.
And then maybe the same question that I asked of Patrice as well, in terms of the South African versus foreign exposure. Are there kind of strategic ranges that you historically have kind of applied, or is it really a fully flexible, free float, kind of free going thing?
The stable fund is predominantly 95% South Africa. You know, where I say that is, you know, when you start investing in Naspers and BCI and ANH, it's not South Africa anymore, but per the classifications, you know, this is a South African fund, whereas the accelerator fund can go up to 10, 15, 20% of offshore product. But yeah, so we again, you've got the different pushes and pulls in terms of offshore exposure, as well as where you understand and where you're seeing the opportunities in the current space.
Thank you very much for that, Matthew, and thanks for addressing the questions of what to ask your hedge fund manager. I think those are very pertinent and good inputs.
Yeah.
We'll pick up with some more questions with you at the end.
No, thanks very much, and thanks for the opportunity, and hope everyone learned a lot more about the stable fund, the benefits of hedge fund investing, and why in these markets hedge funds are actually quite a good place to invest. And then, interesting questions to ask your hedge fund manager. Thanks very much,
Thank
guys.
you. Thanks, Matthew. We'll ask you some more questions at the end, hopefully. We're moving over to Gareth from Corian. Corian has a range of retail hedge funds covering essentially 3 profiles. I think they are all 3 in the multi-strategy space, if I'm correct. So moving a bit into a different strategy sphere compared to the long-short funds that we've covered with Patrice and with Anchor. So Gareth, over to you. Thank you.
Thanks very much, Pierre, and thanks everyone for your time. Always exciting to speak on hedge funds. So yes, Corian's investment thesis and philosophy is very much driven around multi-strategy investing, and really core to that is diversification. Hedge funds for us, especially in the South African hedge fund industry, offer irrefutable proof that they've performed well, and there are certainly diversification benefits to a balanced portfolio. Within the South African hedge fund construct, though, it's also important to note we've got a great choice. We've got different strategies, your major strategies, which have briefly been touched on previously in the last webinar. Long short equity dominates in the South African space, but we've got great fixed income strategies within long short, also market neutral. There's a handful of commodity strategies, and then obviously multi-strategy where our hedge fund range fits in. But we've also now got a very broad, not very broad, but a reasonably broad range of fund managers, and those fund managers offer obviously this diversification with these strategies. So with that, not only do hedge funds as an industry offer diversification, within the hedge fund industry in South Africa, there's a lot of diversification benefits to be had. The one negative to that is when you are picking single managers, unfortunately, you do run the vagaries and risk of picking a manager that may underperform for certain times. I think Matthew alluded to it now. Unfortunately, the nature of investing is, and markets in general, is cyclicality, and not every manager, not every strategy can perform in all markets all of the time. And hence our investment thesis is around the diversification and constructing portfolios that should give you a more predictable return profile. I think a great example to look at here is looking at 5-year returns of South Africa's long-short hedge fund managers. I think, first of all, what's great to see is that these managers have, by and large, performed exceptionally well. But you can see that there is a lot of differentiation through time, and specifically at different points in the cycle where some managers outperform and some underperform. So for us, what we're trying to do is make sure that when we are blending and differentiating managers, you're differentiating strategies and managers that are complementary, which does de-risk some of that single manager or single strategy selection. And how you do that is you need the right tools. So when we're bringing alternative investments into portfolios, and specifically hedge funds that we're speaking to now, you do need to have the systems and the risk ability and capability and experience to look through and understand what actually underlies these hedge funds, what underlines the hedge fund exposure, and by implication, what type of risks that you're going to be getting out of these hedge funds in the market. So over time, our business has invested a lot in systems. We've got proprietary systems that have been developed, and our business, Corian, was actually born out of hedge funds. So our risk systems and database runs back to 2001 in the founding of the business, and really been built around analyzing investment managers and looking through and understanding the risk from a quantitative perspective that portfolios and your strategies can be exposed to. So any of our investments within our multi-strategy solutions, we will look through and understand what sectors we're going to be exposed to. Are we underweight, overweight relative to benchmarks, relative to other managers? And what's really important is in the long only space, a lot of managers are benchmark cognizant. At least some are, very heavily benchmark dependent. But in the hedge fund space, managers tend to differentiate a lot more. So it's important that we understand at any point in time what risks we're exposed to. Obviously, looking through asset classes into the sectors and super sectors, and really knowing how the portfolio should perform in different market conditions, and the aim always being not to surprise investors from a risk perspective. What we can't do is predict returns, but what we can do is try and control what type of risk our investors will be taking on by investing in the different solutions that we offer. So when we're identifying these risks, there's a lot of things to look at. So first and foremost, probably in its simplest term, is looking at your net and gross exposures of the underlying strategies, and then how that will roll up into the multi-strategy solutions. The sensitivity to different market conditions. If markets fall, what's going to happen to the fund? Different levels of stressing the portfolio. Where our concentration is, to whether it be to large caps, to different sectors, trying to understand relative to beta in the market also, knowing where your top net exposures are. And I'm not going to go into too much more detail, but suffice to say, when you're looking through this, you will see the type of psyche that we have in our portfolio is very much around understanding the risks and how we blend these solutions to give that more predictable outcome. With that look through into the underlying positions, what we also try and do is explore new managers and understand new strategies that are coming to the market. If you've got the risk ability and the risk systems, we are not afraid to invest and seed new managers. And I think it's something that we've been proud of over certainly the last decade, is seeding a lot of new strategies and managers in the South African market. Because if you've got the risk systems to look through to these underlying managers and strategies, you don't need to be afraid to actually back new managers who've got the skill, got the experience, and are coming to the market. So what that also gives us the ability to do is negotiate better fees for our clients in seeding these managers. But also a lot of these managers will tend to be more agile because of smaller assets that they manage. And one of the benefits that hedge funds offer is agility and the ability to move around the market. So we really embrace new strategies and styles, and that just adds further to the diversification benefits within our portfolio solutions. Our team is also is quite experienced. I think, you're fortunate in South Africa to have some of the best hedge fund managers that we're aware of. The South African hedge fund space, it continues to produce brilliant managers, and these hedge fund teams have also gone into the back to build and become the foundations to build great long only businesses. Within our business, we've got an experienced team too, which have been exploring the likes of and understanding the likes of Patrice, etc., who've been around for a long period of time. David Bacher, our CIO, was one of the pioneers of the multi-strategy, multi-manager hedge fund business in South Africa. But we like to believe that we've got a very experienced and deep team when it comes to understanding the hedge fund manager space and risks around constructing these portfolios. Essentially, what does this all come down to, and what is our edge and differentiator? And we think it is really taking that risk management, understanding how and what our managers are doing, and then blending them. And I think that, we're all acutely aware of the traditional multi-manager, multi-strategy construct, is that if you take a number of managers and you put them together, you're going to have a fund in the middle that essentially will be more consistent. Investing in a single manager through a cycle, potentially going to outperform, but what you're trying to do is reduce risk and give a more consistent payoff profile. Unfortunately, times when investing in a number of managers, they can drift, and that can be driven by a number of factors. We've had a very volatile market cycle this last month. Managers at times can see the same opportunities, and that perceived diversification can sometimes, in different cycles, unfortunately cluster and become correlated, and that diversification benefit that you thought you had wasn't there. So where we spend a lot of our time is making sure when we're looking through to our underlying positions is that if that does happen, we've got the ability to actually hedge out that risk. What you don't want to be doing is hiring and firing managers or changing strategies consistently. What we want to do is we want to back managers and strategies who we know can perform. But at times, if the portfolio's got risk, we need a more efficient way to manage that risk. And on the back of that, Corian runs a segregated mandate side by side with its solutions, where we run a risk optimize and control risk at the portfolio level. So should we have times where any of our managers are taking on undue risk or anything that we don't like, or are clustering or correlated for any reason, what we can do is mitigate that risk and make sure that our fund is delivering on the risk and reward characteristics that our investors believe appropriate. So when we identify these risks, what do? There's a number of mechanisms that we've got available. First and foremost, we can avoid certain things that we don't want in portfolio. So at times, currently in South Africa, credit, we're quite concerned about. So in any of our portfolios, we'll make sure that we've got limited to no exposure to credit. If we've got managers who are doing something that we think, we don't want to second guess our managers, but we're concerned about the risk, we can hedge that out. And then you have instances where managers actually potentially are all seeing things the same way. You may have managers who don't like gold and don't like it in a portfolio because they don't understand the gold price drivers and don't want to include it. We can include that too. So for us, it's important that we've got the ability and the psyche to say, we don't want specific strategies or we don't want specific asset class exposure. We've got the ability to hedge out risk when we don't want it, or just to mitigate some of the risk in portfolios. And also, if there's any obvious risk premia in the market that are not being taken on all our managers, we can also then add that to the portfolio if need be. And what does that give you? In our view, it gives true differentiation. So, I think the audience that we're speaking to has predominantly is predominantly invested in long-only managers. But by putting hedge funds into your portfolios, whether it be single manager or whether it be in the construct of a multi-managed or multi-strategy hedge fund solution, you are getting differentiation and you're getting that benefit coming to your portfolio. And I think this is best demonstrated, and what we're showing here is, over the last 2 years, the three of South Africa's largest SA equity managers. And what you can see straight away is that there's a very high correlation amongst these managers. So even though you're diversifying in the long-only space, your diversification is often limited because your equity risk premium is going to drive the returns of the portfolios. In the fixed income space, you will obviously have the same thing because managers are long-only. However, if you look through into the makeup of one of our multi-strategy funds, Prosperitas, what you can see immediately is very uncorrelated managers. Yes, there may be managers that may be correlated. We'd be aware of it, and we'd look through where that correlation comes from. But by and large, you're dealing with managers that are often uncorrelated or much lower correlation than you're going to be getting if you're blending just long-only managers. So if you're introducing a hedge fund building block into a balanced solution for your clients, there is no doubt in our mind that either through a multi-strategy approach or even the single managers where you've got these great managers you've got to pick from South Africa, you're going to get that diversification benefit. So our job really is to bring that all together, and what we do is we build and construct solutions. Pierre mentioned we've really got 3 multi-strategy hedge funds that we focus on, and we can really dial in using different strategies. We diversify our portfolios from a strategy perspective, and then within each of those strategies, we then diversify further with different different managers too. So we've got a low risk, a moderate, and a high risk hedge fund range. Within those ranges, we target different beta. Coming with different beta and different risk, you'll obviously get different net exposures, different gross exposures, and then manage the risk at a value at risk basis. So all of our funds are retail investor funds. We manage it according to value at risk from a risk perspective in the RIF regulations. And really what we are most proud of is that over time, our funds have performed. Our funds have performed because we've got great hedge fund managers in South Africa. But really what excites us is that if you take a construct of what we've put against the major asset classes, so being All Share and All B, just putting them together, and then the 3 major ASISA category averages being low equity, medium equity, and high equity, you can see that over the last 5 years, All Shares had a great run coming out of COVID. Your CISA multi-asset, has also done really well. And then as you step down from a risk perspective, you're going to your medium equity and low equity category averages. But if you look at the 3 hedge funds that we manage, what we are doing and what we have demonstrated through many periods is that you are managing to produce returns at a lower risk than you would be getting from your CISA category averages, but getting enhanced returns too. And that is really what we are most proud of, is that it's all very well delivering returns, but it's being able to deliver returns, the targeted risk that your clients expect, and to make sure that you're adding value for a broader balanced portfolio and solution. And I think lastly, speaking to the South African hedge fund industry, we're coming off the back of some really good returns, but the South African hedge fund industry has performed for a couple of decades now. Brilliant managers, well regulated. We've got a framework in the CIS, Collective Investment Scheme infrastructure. And our belief is that South African hedge funds are going to continue to perform. This is the time for hedge funds. When you've got volatile markets like we've got now, this is the time that we believe that the South African hedge fund, the South African financial services industry should be taking note of hedge funds, because we think returns are here to stay. That's it from my side, Pierre.
Thanks, Gareth. It was very interesting. We've got a minute or 2 for questions. So I've got a few questions I want to ask you. And the first one is, you mentioned seeding new managers and early adoption of managers. And the initial question I planned to ask you was, how you build conviction around that and how you mitigate risk. But I think you preempted that by referring to the analytics and the technology. So maybe the more interesting question to ask would be to say, in that process of looking at new managers, have you had any examples where you had a near miss, where you felt, you could have gone for a manager? You don't always have to name names, but have you had examples where you looked back and you said, well, our analytics saved us? As an example to the listeners as well, that one really needs to look at these things in a fair amount of detail.
Yeah, so I think the analytics serve 2 purposes. It's first of all, it's the screening process before we include them into the solutions. And then even once we're including them, we will always include them at a small weight. And as the return profile pays out with expectation, we will then add an increase. So what has happened through times is that certainly we've avoided some strategies, but it would be a blatant lie to say that we haven't got it wrong. But where our risk systems have played it out is that when we introduce a manager with a small allocation and it is not playing out according to what our expectation was, that is when we would immediately exit managers. So our solution, it's I think, Patrice alluded to it earlier. We don't want a whole lot of tail of investments. We want conviction. So when we include a manager, they need to become meaningful in the portfolio or they need to be exited. We don't just sit with that. And that is borne out by making sure that our expectation from whether it be holding patterns, how long they hold for, how well they cut their positions, their drawdowns, those are the types of things that we keep an eye on. And that helps us in containing the risk in the portfolio. And once again, remember, we're rolling this up to a top level where it's blended with a whole lot of other managers. So we introduce small and conviction will lead us higher. And that's where the systems have helped us.
Thank you. There was a question that came in from the audience related to what we've been speaking about now, and it says, excellent presentation, thanks Gareth. And then it says, you mentioned new and exciting strategies in the hedge fund space in SA. Please delve a bit deeper, maybe give an example or highlight a new or recent strategy that you found that is specifically compelling. So, anything special that you feel you've discovered in the recent past.
Yeah, I think probably the most exciting strategy, and I think what is also important for us is that we run a lot of segs with managers. So we don't actually have to go, when we're seeding a manager, we don't need to go and seed into a brand new hedge fund structure. We'll bring the segs into our fund. Probably the most exciting strategy, and it's not that new for us anymore, is a commodity strategy and a commodity manager that we've had in our portfolios for, must be going on 5 years now, where, the researched, an unbelievable manager, passionate about commodities. Commodities isn't something that is mainstream in South Africa. We've got one very, very, very famous commodity hedge fund manager in South Africa that's done exceptionally well for probably 2 decades. But this manager, he managed his own money. We looked at how he managed his money. We analyzed his data. We then invested a small amount of money, made sure that it matched to the risks that we're doing. And, fast forward 5-6 years, and he's been one of the best performers in our multi-strategy funds over that period with significant compounding returns. So, it takes, we don't just, our investors back us with money. So it's very important that we do a hell of a lot of work before we invest. But it's great to find some unearthed talent like that.
And a last question from my side, on your slide where you compared the 3 products against each other, the current net equity exposure of the Prosperitas was actually lower than the multi-strat. How should potential investors understand that?
Yeah, so Prosperitas is slightly nuanced in that it has got a lot more dynamism around its net exposure. So it's more trend following in terms of the strategies that we've got included there. And if you actually look at the beta, if we go back to the beta on there, you can see that it says 0.3 to 0.7. I've noted it is very dynamic. So because of that, the nets and grosses in this fund move around a lot more. They're a lot more stable in absolute, the low risk and moderate. This is a higher risk solution. At times it can have high nets. This fund is one of the only funds in South Africa can have net at fund level short exposure. So that is why it is dynamic and noted for that reason, but well picked up that it is, and hence high risk. So it's one of those funds that at times can be exceptionally low risk. And if you look at its vol, but the guys can press the accelerator when need be.
Cool. Thank you very much. Great presentation. We'll get back to you at the end, maybe with a few more questions.
Thank you, Pierre.
We're going to move on to our last hedge fund presenter before we speak to Gideon, and that is Werner Prinsloo from Exchequer. Welcome, Werner. Welcome to share your presentation.
Good morning, Pierre, and good morning to the audience. And thank you very much for the opportunity to share some of my views with you guys today. When we were asked to join the, let me just share my screen, sorry. One second for me.
Yeah, we can see it.
Okay, brilliant. Yeah, so when we were sort of asked to join the meeting today, the brief that came out was to sort of maybe zoom in on some sort of questions that you can ask your prospective or current hedge fund manager. Now I've been through a fair bit of due diligence over the years, and I thought maybe to zoom in and focus on some of the questions that I found sort of interesting, relevant, and maybe a bit sort of out of the norm. The 5 that I'll be focusing on today is sort of what makes your fund or strategy different or unique. How do you generate your ideas? How do you view and approach risk management? What is, can you maybe highlight one of the bigger mistakes that you've made, and important, what have you learned from it? And then lastly, how much of your own money is invested into your fund? I'll look at these questions from Exchequer's perspective and maybe run you through how we would answer those if you were the person on the other side of the table doing the due diligence. Now, it's always tricky to say why your fund may be different or unique, because simply you don't really know how the other guys manage their funds and how they do it and what their sort of edge is. But trying to think why Exchequer could be different. I think the very first thing that sort of is important for us is the saying there by Andy Grove, and you might recall he's the Hungarian-born co-founder of Intel. He fled Hungary at the age of 20 with just about a backpack on his back, and made it all the way to America, and obviously then built a very successful business. But he said only the paranoid survive. Now, that really resonates with us and is important for us, because I think to be in the market and to be successful in the market, you need to be paranoid. We've seen it this month again. Things are always happening. There's always something on the go. You can just never sit back and think, I've got this figured out. You've got to be paranoid and make sure that you are sort of in touch with the market and know what's going on. And then obviously we want to survive. We've been around for almost 20 years, and we'd like to be around for the next 20. So we like to survive. So I have to try and think how we differentiate ourselves. We like to protect the downside and then participate on the upside. Our strategy is mainly a market neutral strategy. That's sort of our DNA and the strategy that we've been running for the last 20 years. And I've been in a few instances where you are sort of down 2 or 3% for a month. And in order to move forward next month, you need to make 3.5%, 4%. Now that's easier said than done, because things don't always correct immediately. So for us, it's better to avoid being down 2 or 3%. And then when there is sort of upside in the market and money to be made, we then like to participate in that upside. Secondly, and to use a bit of a cricket analogy, is for us, it's a 5-day game. The shorter formats are very entertaining, and lots of sixes and wickets and catches in the T20s. But for us, it's a 5-day game. We don't want to swing and miss and get bowled over, and that's sort of the end of your innings. So we go slow and steady, and we really go for the singles to build our innings. Thirdly, Einstein said the 8th wonder of the world is compounding. We've seen it over the years. We've seen compounding in action. We believe in it. It works. So yeah, we like to use our steady outperformance to unlock that power of compounding. And then lastly, although it's not always nice to be in difficult or volatile markets, but we actually do thrive in those. I think it's because of our market neutral strategy, not really having a high degree of market exposure. But then obviously there's dislocation in terms of crisis. So we find nice opportunities that can hopefully make us some money in the months when the market sort of settle down. And to sort of prove to some of these that we believe, or some of this uniqueness, This is a snapshot of the market in 2018, third quarter of 2018. The Fed started making noises that they're going to start interest rates. We've had negative or low interest rates since the GFC, so that was about 8-9 years, and the market didn't take very kindly to that. The S&P and our own market fell almost 20%. And during that time, our fund was up sort of 1%, protecting the downside. Then early in December, the Fed actually gave the market a very nice early Christmas present, and they pivoted it from actually raising rates to saying that they're going to cut it even further. That ignited the markets. The markets rally about 20% to end the period sort of almost flat from pre the Fed's announcement. In that same period, our fund managed to do 8%, and we then hence participated on the upside. Going for the singles, this is a histogram of our monthly returns, and you can see about 2/3 of our returns are between 0 and 1 and 1 and 2%, and that's really the sweet spot for us. If I can do 1% every month and compound that for 12 months, that brings me to 15% for the year, and I'll be very, very happy with that. So that's really what we strive for, is going for that singles, slow and steady, and not going for the sixes and maybe having a down 5-6% month. The power of compounding. The one thing that Einstein didn't tell us is how to go about to achieve that. We believe one of the key ingredients of compounding is to protect the downside. If you can protect the downside and just keep chipping away, then you'll set that compounding into action. And this is a slide of our 12-month rolling returns since inception of the fund. So it's almost a 20-year track record. And you can see we've had only 2 small blips where the fund actually had a negative 12-month return over the period. And these are the sort of the ebbs and flows. Internally, we sort of aim for 10%, and we also use this as a gauge to see sort of where we are. And if we're below, we know that we're underperforming, and if we're above, then we're happy. Then we're doing better than what we're aiming for. And then finally, being what we call a parachute in tough times. These are just a few years where there were sort of difficult equity years. 2008, very well documented. The GFC, the market was down in excess of 40%, ended down 20%. That was a good year for our fund. 2011, 2016, 18, and 20 as well. So hopefully demonstrating that it is the tough times where our sort of strategy really comes to the fore. Moving on to idea generation, sort of how do we go about to look at opportunities and to look at the market. We've got a dynamic process where we determine 12-month price targets for the universe that we look at. And this is a live sort of dynamic model. So each and every day, I know exactly what our 12-month target prices are for all the banks, all the retailers, all the industrials. Then the market movements around and away from these target prices is sort of what sets off the idea generation. If I look at the market and I see there's 10% upside in Standard Bank and maybe 5% downside in Nedbank, that triggers the idea. We don't just then go rush out and do the trade. We then start the process where we then start the work and we roll out our sleeves. We do the fundamental analysis. We put the two next to one another. We compare. We use the tools that we've developed over the years, and only then do we decide if we still like the idea. That is a trade that we're going to execute. We read really extensively. We get lots of local and international research. We talk to the sell side. we talk to industry experts, we talk to management teams. So all this throughout, can be a trigger to generate an idea for us. And maybe it's not always a direct idea. You talk to someone and you pick up on something that's maybe relevant to another company or to another industry, and that can also then trigger the idea for you. And yeah, like I say, as a team, we constantly reading, thinking, analyzing, and then when we find something that's interesting, we'll get together and we'll discuss that. Looking at risk management and what we do, we prioritize risk management. I like to say I like to sleep well at night. I don't like watching Bloomberg TV until 11 o'clock to try and figure out what's going to happen to my portfolio tomorrow. I know if I walk in, I should be fine, whatever sort of happened overnight. So we really work hard to make sure that the risk management side of the process is taken care of. We've developed and fine-tuned our approach for over 20 years. As a fund, we do mostly intra-sector pairs trading, so we'll have a long and a short within the same sector. We stay neutral or as far as possible on the overall book, and we then try to stay neutral of the following factors as well. Market cap. So I don't want to end up in a position where I am long short caps and short large caps, because in a time of market crisis, we know that the short caps, you just can't get out of them, and that could spell trouble. We like to stay neutral of liquidity. So I don't want to be long of illiquids and short of liquids. It points a little bit to the previous point as well, but even some short caps some long caps are less liquid and more tightly held. We look at commonality of the two shares. Are they the same? Do they have the same drivers? Do they have the same market exposures? Because even inside the same sector, you do get companies that are different. They invest in different markets, or they do business in different markets, etc. And then something that's very important and dear to us is quality. We've learned and seen over the years that there's no substitute for quality. So again, we want to make sure that we don't end up being sort of short quality, or go long of sort of less quality and short the better quality names. And then we do factor analysis, making sure we stay sort of neutral on FX, on interest rates, commodities, and then sectors. And then we also limit our overall position sizes to 10%. We very seldom go there. We also operate on around 4 or 5% maximum position sizes. Then biggest mistake. I think some of our astute managers had no exposure to Steinhoff. A few were even short, and kudos to them. We unfortunately had a position in Steinhoff at the end of 2017, and we've talked at length after that, sort of what we did wrong, what went wrong, where did we get it wrong. And today I'm still not, the reasons why we had the position, I think were still valid. It's obviously now with hindsight very easy to say, it was a mistake. But if we looked at the reasons why we had a position in the company, I still think they were good reasons. I think our biggest mistake was the position size that we had in Steinhoff. Yes, there were warning lights. There were issues that were being flagged, and I think given that there were these warning lights and these issues, our size was probably too big, given what was in the market. So if we had a smaller size, the impact would have been a lot less. So yeah, for us, that's the lesson that we've learned from our position in Steinhoff. And then finally, How do you view co-investment? For us, it's very important. You've got to be aligned. And for us, a substantial part of our net worth is invested into our own fund. For staff, bonus are invested into funds and then sort of locked in for a period of time, for a 5-year rolling period. And then finally, we don't engage in any PA trading. We invest in our fund, and that's where we want to make our money and make money for our investors alongside us. All right, that's the end of my presentation. I'll stop at this point and see if there are any questions.
Thank you, Werner. That was great, and some great pointers of angles to investigate and questions to ask of your manager. You've got 2 funds. You spoke mainly to your market neutral fund, but you also have a multi-strat fund. Do you maybe briefly want to touch on just kind of positioning that versus the multi-neutral in terms of the risk characteristics, to give people a handle on it?
Yeah, the multi-strat fund incorporates some other hedge fund sort of trading tools. It includes bonds, and we run a bit of a long-short strategy in there as well. It's just a differentiator. I think, you've seen from the Corian presentation the benefits of having a diversified fund. The fixed income fund that we use, very uncorrelated with us. They tend to, when it's a bit of a tough time for us, they tend to come to the party and they deliver. So it kind of complement each other. The two complement each other quite nicely, and yeah, that's sort of on the multi-strat side.
And then, do you invest in foreign shares at all in the products?
We only look at sort of JSE listed shares. Like someone said before, the JSE is quite foreign these days. We've got many sort of multinational companies, so we do invest in those. But our universe is predominantly JSE listed companies.
Cool. Thank you very much, Werner.
Thank you. Thanks,
Appreciate
guys.
that. And we might have another question or so at the end. Thank you to all the hedge fund presenters. It was really interesting. I think there were some good pointers for prospective investors, and good information about your strategies and your product. I appreciate that. We're now going to switch over to Gideon Nieuwoud. Olga, maybe you can kind of spotlight both of us so we can see each other nicely. Yeah, there you go. Gideon is dialing in from New Zealand, so I'm happy in the first place that he had the time right and didn't kind of get the time difference wrong. But we've known each other for a very long time, myself and Gideon. So thank you very much, Gideon, for joining us and for your time today. And I'm hoping it'll be I wouldn't say the more entertaining part of the presentation or the session, but a entertaining part at least. Gideon has a long career of experience in financial services and in international markets. Currently, he splits his time between the UK and South Africa, I think it's fair to say, and he has his own business set up that he runs from Hermanus, mainly doing fundraising for international fund managers. I think is a short explanation, but his early career was very much focused on asset consulting and specifically on hedge funds. So Gideon, with that background, I think maybe as a start, just talk us through your hedge fund journey internationally, and then maybe with the point of some international insights that you can offer South African investors of things that you've learned in the international space that can be applied by investors in South Africa.
And thank you, Pierre, and thank you to also Olga and Tanya and the Apex group and colleagues for inviting me to speak. A very long time I will quantify. So I first met Pierre more than 30 years ago when I was, I think, in standard 8 or 9, and were weighing up my options of what I should study. And Pierre very generously wrote me, I think, a 2-page letter as a second-year student in actuarial science, explaining to me the benefits of studying actuarial science. And I think that speaks through to the DNA and the lessons learned. At Southern Right Capital, we believe in the compounding of knowledge, then compounding of relationships built on that knowledge, and then the derivative of that is compounding capital. So I've started my career in finance about 25 years ago, in the late 90s, early 2000s, and it's been a learning experience ever since. I worked at a major investment consultancy business, what is now called WTW. It was quite a privileged position because going into, I started there in October 2000, and had a little bit of knowledge around hedge funds, thanks to Professor Mark Claassen, who at Stellenbosch University talked about LTCM and all those hedge funds blow-ups in the final years of our course, when the LTCM, long-term capital management, if people go but in history, they will see the blow-up that happened on the back of leverage. So I went to Watson Wyatt. The person I hired me left at the same time, and during the same time, sort of 2000 through to 2002, equity markets were down 50%. So it was a great time of volatility, and volatility is something on which hedge funds can bounce. And the pension funds at that point in time had sort of a 60-40 split, 60% in equities, 40% in bonds. One saw in 2001 the 9/11 terrorist attack, and then shoes dropped one after the other, and nothing too dissimilar than what we see today. So at the time, the diversification in funds were not as well diversified as it is today. Like I said, it was sort of a 60-40 split, and it was a great time to invest in fund of hedge funds at first, and then into hedge funds directly, and then later on making direct investments. So where we sit today, we at Southern Right, we form partnerships with investment managers. We invest our balance sheet money first, and then we, as PSA, we raise additional capital. I can, Pierre, if you want to lead it with a few specifics over the 25-year period, I will maybe leave it there with, if one look over the past 25 years, gold have compounded at 10% in USD. The South African rand went from about 6 rands at the beginning of 2000 to now close to 20. So on a forward-looking basis, if you look at what one can get from treasuries, and one look at long-term devaluations of the rand versus the dollar, and you look at what you can get in 10-year JIBAR, I think the par for the course when you consider hedge funds should be that you need to make at least 10% in South African rands, and different times will throw different fat pitches. So I don't know, Pierre, if you want to lead.
Yeah, maybe talking a bit more about the hedge fund environment overseas. Clearly, as you mentioned, how it's developed quite a bit over the last number of decades. But I suppose in all spheres of finance in South Africa, one often kind of initially think that we're behind the curve. You know, we tend to follow the UK quite a bit in terms of our regulatory framework and so forth, but also things like RDR and even product development or product trends kind of themes to tend to pick up from there. But yeah, often the people's kind of starting point is almost to think emerging markets or South Africa will be behind international developments. So I think the first question is, is that true or not? I think there's strong indications that it's not always the case. But then specifically to the hedge fund space, what is the current trends of development in the international space, which is maybe not that familiar to us anymore yet, and whether some of that might come to South Africa.
Yeah, no, I think there's one we need to look at what is your forward-looking expectations, and how do you build return characteristics? Like I view the world as a from a sort of a total portfolio approach. So we look at the return drivers, and then we look at what does the specific return drivers cost, because our return drivers are growth, income, trading, and then price opportunities. But everything comes at a price. I think the par for the course is, let's say, 10 in US dollar numbers, and then you need to look at how do you add value and alpha over and above that sort of long-term returns. So in the hedge fund space, clearly there's been internationally, I've up until sort of 2008, there was very much the large institutional investors went into hedge funds through fund of funds, because there's a lot of due diligence risk. I've met with north of 6,000 distinct investment managers, whether it's a long-only equity manager or private equity manager or venture manager. So there's a lot of due diligence efforts that need to go into picking a portfolio of managers. And then so the hedge fund world migrated from the sort of fund of hedge fund approach to these platforms, and multi-strategy platforms. Some of the larger ones are now north of $70 billion in unlevered or in unlevered equity. So if you put these platforms can be up to 5 to 10 times levered. We're talking about businesses that's nearing $1 trillion, individual fund management businesses. So, and that bring a whole lot of other risks. So, I think in the South African context versus the rest of the world, liquidity is a major driver of returns. So whenever there's a fallout in the hedge fund complex, it's also when there's people running for the door. I think it's strategy by strategy. One need to look at what is the key risk drivers and what is the manager's alpha capabilities versus that risk drivers. But you need to really build it down. And look through the structure and look through the fee structure as well, because you don't want to pay for long levered beta performance fee. So I've started off with LTCM. A great example or great lesson that I learned through LTCM is very few investors price managers like you need to price options, because at the end of the day, when you invest in a manager on a forward-looking basis, you buy a call option on that manager's skill or investor's skill. So if there's a performance fee, that call option becomes more expensive, because with volatility and time, and then the premium, it becomes a more costly call option. So I think one thing that the technology are bringing us through various AIs, I daily use various applications of AI. My favorite is, and I got pointed to it by Stan Druckenmiller, is Perplexity. So there's a lot. This is one of the most, if not the most, competitive market in the world, because it's got great rewards. We've just seen the Masters Golf, and the spread between winning and losing is small, and the rewards between winning and losing are wide, and the same is in finance. So the average club pro, the average investor, is not going to have the success that I've looked at before this. Warren Buffett's compound rate is 20%, so he's double the par of the course.
You mentioned liquidity now, and maybe let's go slightly off topic as far as hedge funds are concerned. But when your broader business invests and raises for more than just hedge funds, and globally, there's kind of more and more private market action and less listed market action in a sense, and we've seen it in South Africa as well, lots of delisting, shrinking JSE and so forth. And then on top of that, there are kind of globally concerns that a lot of kind of things are hidden in the private space, which otherwise would have been kind of a bit more obvious on the risk side. So, do you have strong views, or do you have views on that, where we're heading in a world where private markets become more and more prominent?
Yeah, I think when you take your hard-earned money and you entrust someone with that, you take portfolio risk and you take business risk. And then I think one of the first things that one learn is you need to have your own time horizon. So you can't put money into a private equity fund because it looks like it gives you an attractive return, but you need money for your kids' education in a 2-year time frame, because that is not the right approach. So I think the sort of David Swenson model, the Yale model, has seen some challenges in the most recent market environments, because it's if you look at sort of alternatives, whether it's private equity and hedge funds in a broad sense, venture capital, there's the public markets, when one have seen what we've seen last year with Max 7, on a short time horizon, it looked like you can be in much more liquid, better returning assets. But over long periods of time, you need to sit with consultants like yourself and figure out when do you need what. You can't just drive 60 miles an hour because the speed limit says it's 60 miles an hour. The weather conditions change, and you need to be able to adjust your portfolio to those changing weather conditions. Yeah, so I think it's there's a clear. I think when one look at what Larry Fink have said, he ran towards ESG because there was a product opportunity, a business opportunity, making more money for BlackRock in promoting ESG as an investment strategy. And as soon as that tide of change, he couldn't run fast enough backwards and jump on a Bitcoin. So we need to understand the dynamics. What people pitch you? Do they pitch you a business, or do they pitch you a
Something you need.
Yeah.
Something that you actually need. True. Let's. I'm scared we'll run out of time and not get to the most entertaining part of it. So let's move on to that. And it's coming back to kind of assessing risk in investment, opportunities and in hedge funds. And tell us the story of Bernie Madoff, because I think there's few people. If you Google Bernie Madoff, then the name Guido Nieuwhout comes up in the articles, and there's few people who can, has the claim to fame of that. But I think at least some of the people in the audience will be too young to know even what was that about. So maybe just tell us, when it was in time, where you were, how you got, how it crossed your path, and what the learnings was about red flags and how things kind of can unravel.
Yeah, and Pierre, you do have a way to make me feel old these days. Yeah, so I guess it's knowing, coming back to what was the path for the course. So in 2007, I moved from Watson Wyatt to a big Swiss bank, Unibancaire Privé. At the time, they were one of the largest investors. UBS was the largest, I think, at the time, and UBP was the second largest investor in hedge funds. So pre the global financial crisis, fund of hedge funds were still the way to access the market, as a main, rightly so, because of due diligence and the like. So then there was sort of two different liquidity periods of time. In August 2007, there was several hedge funds that blew up, multi-strats and part of multi-strats. Some of them have come back to life and run big portfolios due to a natural gas spread that have gone against them. And then also the Bear Stearns hedge fund had some issues. And then looking at the returns, and I oversaw a team of research analysts, it became unusual to sort of see. I knew of Bernie Madoff going back to 2001, 2002, and then again during this period of stress, that he basically produced returns like clockwork. It was sort of a 1% a month, and as if nothing has happened. So we at UBP at the time had a lot of money there, and I, being a South African and candid, I guess in a room full of Swiss bankers, were prepared and happy to ask the questions. So we unraveled a bunch of things, and in about 18 months later, he ran out of liquidity because he couldn't raise money fast enough to pay for the redemptions. And funnily enough, a structural change happened after that. Bernie Madoff ran all his accounts in managed accounts because that's the easiest way to I guess defraud people, because there's no alignment. You don't talk like Werner have talked about investing money alongside your clients in the same fund. So there was a lot of red lights, so to say, as it relates to how much assets they really manage, where basic questions, where's their money invested, get talking to their counterparties, calling up big banks and say, look, these guys are talking about the split strike conversion, and nobody could really tell you how the strategy worked. So, and I guess being a cynic, because frauds can carry on for a very long time. So being cynical and critical, you may feel like you lose out. And on this occasion, it was fortunate that I sort of lift my hand and wrote a note, and unfortunately, my note later on leaked, and that ended up in the Wall Street Journal. So it was unfortunate, but at least now it's a timestamp in history that I've raised the hand and was against what looked like a very good investment strategy.
Yeah. No,
Most
it's
of the
interesting,
time,
and I think,
the
obviously hedge funds and particularly in South Africa are now kind of well regulated. So, certainly we don't want to give investors the idea that fraud is kind of a regular occurrence. But I think what I get from what you've said now is that even if it's not issues of fraud or misrepresentation or anything, what is important is to look at the kind of the performance signature of a fund and reconcile it with the strategy and what the manager tells you he's doing. Because even if he's not doing anything untoward, you still want consistency. You want predictability in terms of what you should expect from a strategy and a fund. And history, I suppose, can be a guide as to whether over time something behaves in line with the strategy that the manager claims. So
yeah, it's very hard.
makes sense.
It's very hard to manage for fraud, and like you say, that DNA. We need to constantly look at the DNA. And I'm sort of a bit tongue in cheek. One of the riskiest parts could actually be ETF investments, because if you look at something, and just to be clear, I don't call this a fraud, but if you look at something like, say, SPY, that's started, say, 30 odd years ago, with $5-6 million. Today it's 600-700 billion, and it tracks a number that everybody knows. So if you put $1 into SPY and the S&P 500 goes down 10%, you would expect your dollar to go down 10%. But and in the crypto space, I don't know if some of the listeners are involved in crypto, but there's USDT, which is Tether. So and these things can carry on for a very long period of time, because Tether is backed and it's a stable coin, and every USDT should be one USD, and who knows when liquidity goes, which way these things go. So I think one should be very cynical. One should use experts like Gareth and his team to sound off. And if you build a portfolio, I think you should have some direct exposures, and definitely make sure, because wherever leverage and liquidity and sort of call it off script investments, off benchmark investments are involved, you need to understand that the returns that's been produced are true to what they should produce.
Thanks a lot. Sorry, I was just having a look at the questions that's come in, but I think we'll deal with them later maybe. Kiran, maybe in the last minute or two, you know, I can give you another chance to speak a bit about Southern Right Capital and what you do. Again, you know, maybe slightly off topic for a hedge fund only presentation, but I think you're welcome to briefly say something about that. And also, you know, given the state of the world, and obviously you move around internationally a lot, where you not necessarily with reference to specific products, but where you perceive the opportunities or the likely opportunities to be at the present time.
Yeah, no, thanks for the opportunity. So Southern Right Capital, as I say, we follow a total portfolio approach. So we look at income, growth, trading, and price opportunities as distinct buckets. The price opportunities is sort of a bit of a cop out, where we feel we have a unique insight into a specific asset. And one of the good examples is SAP Pioneer, which is the banking and insurance carve-out out of SAP that we've done and invested in, which is a direct investment. And then in growth, in certain periods of time, like a lot of growth investors with crossover funds, for instance, in 2022, it was a bad time to be in crossover investments. But now, if one sit here today, we're quite positive on looking at crossover investment strategies in growth. And what does that mean? It's investors that invest public equities as well as private equity, late stage growth, but sort of see the compounding effect, the duration of the investments, and the knowledge of the investments going through the cycle, and don't need to sell in the IPO. So it's I think one need to look at what environment, what weather conditions you're driving, and then you lean into specific strategies. We, at the moment, at the trading strategies, if it fits in your portfolio, if you want to run a portfolio, you want to sleep well at night, it's probably good to have a good bit in trading, because the market is throwing fat pitches in that context at the moment. There's a lot of volatility. There's a lot of assets shifts between country allocations, whether it is in emerging markets between China and India. One need to play those sort of changes, and you can do it either through long only equity, or you can do it through hedge strategies. And if you have a capable driver in bad conditions, you can drive much safer, actually. So I'm yep.
No, thank you very much, Kiran. I think we'll stop there with you, but thank you very much for your time. Interesting insights. I think you know, obviously, as I said, international insights is often valuable to think what the local applications might be, but certainly you've had good and interesting experiences internationally, and a very interesting career so far, and we wish you well with your business. Looking forward to do business with you as we currently do. There's the last few questions for the managers, which I think we still got 3 minutes on the clock to go for the session. So I don't know if any of the managers that are still online can come back online, then we can cover some of those. Patrice, maybe to start with you, because I missed the very first panel or question that came in from the audience. It was actually directed at you, and the question was really also about kind of the risk characterization of your products, just in terms of the, you know, the typical gross exposures and the current net exposures and so forth. Do you maybe just want to say a bit more about that?
Okay, I haven't seen the question. Is it one of them in the Q&A?
It was the very first one. I think it might have been already moved off.
Okay.
Let me quickly. It was quite a, yeah, no, sorry. I think it was taken off, but really it just asked about the gross exposure maximum of your fund.
Okay, well, gross exposure is when you add longs and shorts together. Okay, so that's generally around 2.5 times, 2.5 to 3 times. At the moment, we're sitting probably about 1.5, 1.7 times. A net exposure can vary from net 35, net 40 to net 80, 85 even at times. You know, a lot of the makeup, when you look at net 85, it might have bonds in it, corporate bonds. So you need to strip that out. It might have property stocks, they were paying because we would rather park the cash in that stock. So we look at the volatility of each individual exposure. If it's quite big, we'll see how big it is in terms of its beta, I guess, to the market. Because we would be, as I mentioned earlier, sometimes we don't mind having a bigger exposure in something that's quite safe, that can still give you a decent return instead of leaving the cash in the bank. And we can afford that volatility then.
Actually, I now remember the second part of that question was asking about maximum single exposures or single position
maximum
exposures.
single exposures. Okay, well, there's an example now where you're going to get 60% back of your share in 2 months' time. So that one at the moment is at 7%. We'd like it to be at 10 to 12%, but the price has moved. So when Old Mutual is 15% of our funds, when we were writing letters to them, post in 2011, when they decided to unbundle, sell the business in Sweden. We had been engaging with the board a lot. It was 15% of our funds. So we didn't see a lot of downside in the sum of parts of Mutual at the time. So we can go to 15%. 2005, I remember we had 20% in Roynet. Okay, we really like Roynet. So we can, and it worked well.
Prepared to be quite convicted.
My biggest position when I started the hedge funds in 2003 was Pepcore, 10-12% before it got taken out by Christo Visa, and myself and Roger Williams from Centaur together, we wrote a note which we put on in the press about how cheap they were taking Pepcore out. It was 10% of the funds then. Stock went up 30% in a week or something. When they revised the offer again, we made 3%. So yeah, sometimes you can have that kind of level of conviction, and you must put your money where your mouth is.
Thank you. That's I think that's valuable information for clients to have, to understand that the manager can be highly convicted and still manage the downside and the capital protection in the product. Gareth, maybe turning to you, there was a question that highlighted the beta of your products across the range, and then the question essentially was, will you be able to kind of successfully move it up, I suppose is the right way to put it, to not lose out on strongly upward moving markets. I think that's the crux of it. So maybe to flip the question around a bit is, to what degree do you reposition your portfolios when it's a really strong market environment?
So it's easier in a trending market, and it's also hindsight easier to spot a trend. But I would say that it is very difficult in V-shaped recoveries to put on massive amounts of beta. I think that is something that we struggle with internally, especially because of the nature of hedge funds that protect capital. And I think our managers have done really well in that, and the broader South African industry for a long period of time. Often when you get a V-shaped recovery, you'd like to participate more, but timing markets is incredibly difficult. There's a handful of people who can get it right in the world. You're not going to pick the bottoms. I think where we play our role is to make sure that we're not overexposed in specific times in the market. We're not trying to second guess when the bottom is, but what we are very cognizant of, if we're running structurally low beta or nets, that is when we will step in. Less so during crises. Very difficult to do so. Again, you don't know when that bottom is.
Cool. Thank you very much. Guys, we're at time, so I think I'm going to call it there. It was a long session, but a really good session, I think. And I really appreciate that you attended to the brief I requested to focus on your strategies and the characteristics of your products as well, because it's nice to hear about top-down macro and bottom-up stock picking from managers, but for investors to invest in products and opportunities with confidence, they need to understand how they work and what we expect from them, I suppose. So it is important. So thank you very much for having covered that in that way. I think in conclusion from me, and I think it was said by Gareth as well, we really do have good hedge fund managers in South Africa. I think that is kind of beyond question. we've had a number of decades of solid hedge fund return. Obviously, there's a spread of managers. So I think speaking to Gideon and some of the other points as well, that due diligence is important. You have to ask the right questions. Preferably, you have to have the right tools to be able to analyze these things and to blend them to see how they work at the overall portfolio level. Once you start putting them in a portfolio of other opportunities, or whether you build a hedge fund exclusive product, I think that's important. But yeah, we're blessed with good managers, and we appreciate the openness of the managers in South Africa and the transparency generally that we receive from hedge fund managers. And thank you very much for the insights that you've offered. And thank you, Gideon, for the international insights that you offered. It was, I think, entertaining and some interesting angles to hear. To the audience, there will be some further hedge fund sessions. I think BCI is aiming for one every month. So in a month's time, we'll have another panel of managers that we can chat to. And then the normal boutiques on Wednesdays are continuing. There's a boutiques on Wednesday tomorrow morning at 8:30. We will be speaking, that's long only, we will be speaking to Reitway, Global Property, and to Granite on their capabilities in South Africa. So the questions that we didn't get to in the interest of time, we'll circulate to the managers. Some of them will be specific, so we'll get some specific questions from the managers to you. Thank you very much, guys, for your time. You've given us a lot of time. Really appreciate it.